Stop what you're doing and listen carefully. Gold is trading at two completely different prices right now. Not a few pennies, not a rounding error. Here's what happened. Shanghai gold futures closed last week consistently $13 higher per ounce than New York futures for the same delivery date. That's a spread wide enough to drive a truck through. Under normal conditions, that spread gets crushed in seconds. Traders in New York buy, traders in Shanghai sell. They lock in the difference. It's free money. It's the most basic trade in global finance. Except right now, nobody's doing it. The spread isn't closing, it's widening. This isn't a blip. It's not a time zone thing. It's not a liquidity hiccup. This is a structural dislocation that's telling you the rails between the two largest gold markets on the planet are no longer connected the way they used to be. And that matters because gold isn't just another asset. It's the asset central banks are buying at record pace. It's the asset sitting underneath currency regimes. It's the thing people run to when they stop trusting everything else. And right now, the price discovery system for that asset is splitting in two. You need to understand why this is happening now, not 6 months ago, not next year, right now. Because the timing is not random. China has been vacuuming physical gold off the market for over a year. Chinese central bank reserves, Chinese households, Chinese institutions. The demand is relentless. But that demand isn't being reflected in New York the way it should be. New York is still pricing gold like it's 2022, like inflation is transitory, like central banks are still on the same page. Shanghai is pricing gold like the system is already fragmenting, like the dollar's role is up for negotiation, like the next 10 years look nothing like the last 30. The spread between these two prices is not a pricing error. It's a referendum. It's the market voting in two different directions because the participants in those markets are operating under two completely different assumptions about what comes next. And when assumptions split like that, arbitrage doesn't close the gap. It just stops trying. Let's talk about how this is supposed to work. Gold trades in New York as a futures contract. It trades in Shanghai as a futures contract. They represent the same thing, the same ounce of the same metal delivered on the same date. When the price in one market gets higher than the other, arbitrageurs step in. They simultaneously buy the cheaper contract and sell the expensive one. They hedge the currency risk, they lock in the spread, they pocket the difference. The trade is mechanical. It's supposed to be riskless. But that trade depends on something most people never think about. It depends on being able to move the physical metal between jurisdictions without friction. It depends on currency convertibility. It depends on clearing systems that talk to each other. It depends on counterparties in both locations honoring the same rules. And it depends on governments allowing capital to flow freely in both directions. None of that is guaranteed anymore. China has capital controls. You can't just move dollars in and out at will. The yuan isn't freely convertible. Moving physical gold across borders requires licenses, approvals, and infrastructure that can be turned off with a phone call. The arbitrage isn't riskless anymore. It's a political bet, and when a trade becomes a political bet, professionals stop doing it. That's what you're seeing in the spread. This is happening because China has spent the last 18 months building a parallel gold market that doesn't depend on London or New York for price discovery. The Shanghai Gold Exchange is not just a futures venue. It's a physical delivery hub. It's connected to refineries. It's connected to vaults. It's connected to the People's Bank of China. And it's increasingly disconnected from the West. The gold that trades in Shanghai is staying in Shanghai. It's not flowing back out to balance the global market. It's being absorbed into a system that has different goals and different time horizons than the system that built COMEX. You combine that with something else that doesn't get enough attention. Western gold futures markets are leveraged. They're paper markets. The ratio of paper claims to physical metal is somewhere north of 100 to 1. Most contracts never result in delivery. They're closed out before expiration. They're cash settled. They're bets on the price, not purchases of the metal. Shanghai works differently. The delivery rate is higher. The physical component is larger. The leverage is lower. When those two structures try to price the same asset, they don't converge. They diverge, because they're not actually pricing the same thing anymore. That divergence is being amplified by something quieter but just as important. Dollar liquidity is tightening. Not in the headline sense, in the structural sense. The Fed is still running a large balance sheet, but the distribution of dollars outside the United States is getting harder. Euro-dollar markets are thinner. Basis swaps are wider. Foreign institutions are finding it more expensive to access dollar funding. And when dollar funding gets expensive, it gets harder to execute trades that require moving dollars into yuan and back again. The cost of doing the arbitrage goes up. The risk goes up. The spread that used to be free money becomes a spread that might cost you more than you make. This has happened before, not with gold, but with other assets in other fractures. In 2015, Chinese equities traded at a premium to Hong Kong-listed shares of the same companies. The spread was huge. It stayed huge. Arbitrage didn't close it because moving capital between the two jurisdictions was restricted. The markets were technically linked but functionally separate. That premium lasted for years. It's still there in some names. In the late 1960s, gold traded at different prices in London and Zurich depending on who could access which vault and under what restrictions. The London gold pool tried to hold the spread together. It failed. The system broke. Bretton Woods ended. What looked like a small pricing inefficiency turned out to be the leading edge of a monetary regime change. You're watching the same pattern now. A small spread that won't close. A technical inefficiency that's actually a structural message. The message is that the unified global market for gold is coming apart. Not all at once, not with a headline, but in the boring, mechanical failure of arbitrage that should be automatic. Now let's deal with the tension. There are people who will tell you this doesn't matter, that it's noise, that spreads always fluctuate and this will normalize when volatility settles. They'll point out that gold has had dislocations before and the system didn't collapse. They'll say Shanghai is just a regional market with local demand dynamics, and it doesn't mean the whole structure is breaking. That argument has merit if you ignore everything else happening at the same time. But you can't ignore it. You can't ignore that central banks bought more gold last year than any year since 1950. You can't ignore that the BRICS are openly discussing gold-backed settlement systems. You can't ignore that the dollar's share of global reserves is declining. You can't ignore that the Treasury market required emergency intervention twice in 4 years. You can't ignore that the repo market broke in 2019 and never fully healed. The case that this is just noise requires you to believe that all of these things are unrelated, that the spread in gold is a technical quirk happening in isolation. But the stronger case is that this is one more piece of evidence that the financial architecture built after World War II is losing coherence, that the assumptions baked into that system are being tested by actors who have different priorities and different leverage than they did 20 years ago. The bull case for ignoring this assumes the system self-corrects. The bear case assumes the system is past the point where correction is possible without something breaking first. What happens next depends on whether the spread closes or widens. If it closes, if arbitrage comes back, if the price in Shanghai and New York start tracking each other again, then maybe this was just a temporary friction, a moment of stress that passed. But if the spread stays wide, if it gets wider, if we start seeing sustained dislocations across other metals or other asset classes, then you're not looking at a bug. You're looking at a feature of a world that's bifurcating into separate financial zones with separate rules and separate prices for the same things. Watch the delivery data. Watch how much physical gold is actually moving out of COMEX vaults versus how much is being rolled into new contracts. Watch the yuan gold price independently. Watch whether Western institutions start acknowledging the Shanghai price as relevant or whether they keep pretending it's a side market that doesn't matter. The spread is not the story. The spread is the signal. It's telling you that the infrastructure connecting the global gold market is under stress. It's telling you that the players in that market don't trust the same things anymore. It's telling you that price discovery is fracturing along geopolitical lines. And when price discovery fractures, it doesn't come back together cleanly. It resets. The question is what that reset looks like and who's holding what when it happens. This isn't about predicting a crash. It's about recognizing that the system is already adjusting to a reality that most people haven't priced in yet. The $13 spread is small enough to ignore. It's also large enough to be impossible under the rules that are supposed to govern how these markets work. And when the rules stop working quietly, they eventually stop working loudly. Stay aware, watch what moves, and understand that the price you see might not be the price that matters.